Ed, it's always great to have you, and particularly at the start of the year when we try and read the tea leaves of the direction of oil, which has actually been up above $80 again, increasing some inflationary pressures. Why do you think we're going to head to a surplus? What does that mean for the price point?
Well, there are two things. One is we're moving out of winter, and winter has been pretty vicious. There's been kind of a change in the relationship between oil and gas prices. Normally, on an equivalent basis, oil prices higher than natural gas. We've had natural gas pricing higher than oil, which gives rise to a switch to propane, switch to diesel for heating purposes here and there. That's several 100,000 barrels a day. We've had actually disruptions to supply, some weather-related, some not, between Ecuador and Libya. That's 1 million barrels a day out of the market, a little bit of a scare in Kazakhstan. But I'd say these are temporary seasonal factors, and we're moving out of winter eventually. And yes, you've mentioned all of the issues associated with the uncertainties of the natural gas into Europe. But natural gas has been incredibly tight. It has been a colder than normal winter. The winter is turning normal. We're expecting milder temperatures in January, February, and March in the heart of Europe and Germany than we had in October, November, and December. That should ease up. There's much more LNG going to Europe than there was in September and October, and that should ease supply factors up also. But you just don't know where the Ukraine talks are going to go.
Ed, interesting. We talk about the dynamics of nat gas. Come back to the oil markets as well for us here. When you look at supply and demand dynamics into this year and into next year, is it a demand recovery story or a supply constraint story?
So I don't think it is certainly a recovery of demand, but I think it's a supply recovery as well. And people are focusing a little bit too much on the supply constraints. There is spare capacity in OPEC countries. To be sure, if you look at what the OPEC plus countries have been saying, namely adding 400 and some thousand barrels a day per month to the markets, they're shy of that by about 140,000 barrels a day. That's because some of them, and you can name them, like Nigeria and Angola, Algeria, can't produce any more than they're producing, but others can. There's some talk about Russia running out of spare capacity, but we've heard that year after year. And their capital spending is up. It's easy to debottleneck. It's easy to bring on greenfield projects, and they've got a lot of brownfield they can bring back. So we think they can. They still have around 500,000 barrels a day right at the moment, and we think they can add another 500,000 to 800 a day by the end of the year. So we're not as concerned as others are about Russia being hamstrung in the market. Saudi Arabia is far away from its 12 million barrel a day capacity level. They're increasing capacity. UAE is far away from its probably 4.2 million a day capacity now. They're about 1 million barrels a day away from that. They're going to add more to that as well.
Ed, we have to get your thoughts as well on natural gas. And I guess what some people are looking at as an energy crisis over there in Europe, certainly in the short term, there's a crisis there. I guess the bigger question here is longer term, do Europeans have anything to worry about?
Well, I think they have something to worry about that's not exactly in the framework of what's happening in Ukraine. The European Union has been ambitious about moving off with fossil fuels. They've banned effectively thermal coal in power plants. They've made it very difficult to finance new combined cycle natural gas power plants. They're relying on renewables. And the year has not been good for renewables. They were down on hydro through the summer and through the winter. They've been down on wind power, both in the month of September and the month of December, which means a higher need for fossil fuels. So they have a puzzle to deal with respect to the reliability, the resilience, the redundancy that's in their power system. They've been a little bit too aggressive for going off of fossil fuels and onto renewables, and they may be paying a little bit of a price for it. So we'll see what they do in terms of doubling down on renewables, where there's not enough battery power to really make up for intermittency, or whether they'll do something on the natural gas side.
That renewables, that shift to low carbon energy, in many ways, Ed, has fostered the growth that we've seen in base metals as well. Copper's been on a tear, some of the other areas that have been bets on this transition. Where do you see metals going out for 2022? Are we still talking about a super cycle up on our hands when it comes to commodities?
We are certainly not talking. We are not talking about a commodity super cycle, but we join in with those who are talking about a metal super cycle. So there are a couple of elements to it. You need metals basically to decarbonize the planet. It is a very metal-intensive operation. You need copper and aluminum for power distribution. You need aluminum for the framework of cars. Particularly, the more we go into EVs, the more we're going into lighter metals. So the demand for metals is going to be there in order to decarbonize. They're pretty dirty in the process of making them. So there's a debate that we think is solved, namely that using metals may be dirty, but it cleans up more than it dirties. So there's a net positive that we think is there. We're looking at maybe a decade-long process where demand for metals is going to go up and prices are going to rise too.